What if the biggest thing holding back your financial future isn't your paycheck? It's the obligation you carry every single month. The day the last mortgage payment clears, it doesn't just change your bank account, it changes your decisions, your risks, and the way you live. Almost nobody talks about what that day actually means. Today, we will. Most homeowners never reach this finish line early. Here's how to change that. Subscribe for more strategies to take control of your money. Section 1. The math nobody wants to run out loud. The average American mortgage payment in 2026 is around $2,350 a month, principal and interest only. Buy or refinance recently, you're probably closer to $2,500. Median household take-home after taxes and Medicare? About $5,300 a month. Before groceries, gas, or your kids' school supplies, your mortgage is already consuming 44% of your income. Financial professionals generally recommend a safe limit of 28%. Most American families are running 15 points over that, every month for decades. That's not a budgeting problem, that's structural. Section 2. Meet the Hendersons. Marcus and Diane earn $112,000 combined. 2 kids, suburban house, bought in 2021. On paper, doing fine. Take home after taxes and 401k, about $6,900 a month. Here's where it goes. Mortgage, $2,500. Property taxes, $390. Insurance, $210. Maintenance reserve, $330. That's $3,430 just to legally live in the house. Remaining $3,470. Car payments, $820. Insurance and gas, $490. Student loans, $580. Health insurance, $370. Groceries, $720. Utilities and phones, $430. They're left with $60. No savings cushion, no flexibility, no room to breathe. And every time Marcus thinks about asking for remote work or Diane circles back to that business idea, one question kills it before it starts. Can we still cover the mortgage? That question runs in the background of their entire lives, like a tab they can never close. Section 3. What actually gets released when it's gone? Here's where people get it wrong. When the mortgage disappears, you don't get the full payment back. Property taxes, insurance, and maintenance still exist. On a $400,000 home, that's roughly $840 a month. So if your payment was $2,500, your real new freedom is about $1,700 a month. Still think that's small? It's not. $1,700 a month invested in a basic S&P 500 index fund at the historical 8% annual return, 5 years, $125,000, 10 years, $312,000, 15 years, $592,000, 20 years, $1 million. You contributed $408,000, the market added nearly $600,000. The majority of your wealth came from compound growth, not grinding harder, just from finally giving your money room to move. If this is clicking for you, tap like. It helps more people find real personal finance content right when they need it. Section 4. The debate and what it's missing. Someone in the comments is already typing, if your rate is under 5%, you're better off investing the difference. That's not wrong. Historically, equities beat low-rate debt in most 30-year windows. Under 4.5%, investing the difference usually wins on paper. But the spreadsheet assumes you'll actually invest it. Most people don't. The mortgage was forced discipline. When it's gone and replaced by discretionary cash, many households absorb it into lifestyle within 18 months. Better car, more dining out, and the spreadsheet argument never made it to a brokerage account. Here's the honest framework. Rate above 7%, aggressive payoff is hard to beat. Between 4.5 to 7%, genuine judgment call. Below 4.5%, invest the difference, but only if you actually will. The real answer was never just a number. It was always about knowing yourself. Section 5. What the research found. A 2019 study from the National Academy of Sciences tracked what happened when people's debts were fully eliminated, not reduced, closed. Anxiety dropped 25 percentage points. People performed measurably better on cognitive tests. They became less impulsive and more future-focused. Here's what surprised researchers most. The number of accounts closed mattered more than the dollar amount of relief. Closing a $3,000 credit card created more psychological improvement than reducing a $10,000 balance. The brain doesn't track dollars, it tracks open tabs. For most people, the mortgage is the last one, the biggest one. When it finally closes, something shifts that's hard to describe until you felt it. Northwestern researchers separately found that carrying high debt correlates with higher blood pressure, higher rates of depression, and worse physical health, even after controlling for income. This was never just a financial weight. Your body was carrying it too. Section 6. The freedom number. In financial independence math, you need roughly 25 times your annual expenses to sustain yourself without working. When the Hendersons pay off their mortgage at year 22 instead of year 30, their expenses drop $1,700 a month. That's $20,400 per year they need to survive. Multiply by 25, they just cut their financial independence target by $510,000. No raise, no inheritance, no side hustle breakthrough. They just changed what survival costs. That number controls everything, whether Diane can take the lower-paying job she actually wants, whether Marcus can have a slow quarter without it becoming a family emergency, whether either of them can finally make a decision based on what they want instead of what the mortgage requires. Section 7. How to get there faster. On a $450,000 mortgage at 6.5%, the standard payment is $2,844 a month. Total interest over 30 years, about $574,000. Bi-weekly payments, pay half your monthly amount every 2 weeks. That creates 13 full payments per year instead of 12. Result? About 6 years off your loan and $89,000 in interest saved. Extra $500 per month to principal shaves 7 to 8 years and eliminates about $150,000 in interest. Extra $1,000 per month cuts the loan to roughly 17 to 18 years. The difference between finishing at 55 versus 63 is not a small difference. It's nearly a decade of your life. Section 8. First moves when it's done. Last payment processed. Here's exactly what you do. First, verify your lender filed the lien release and you have your deed. This gets skipped occasionally. You need it on record. Second, rebuild your emergency fund. Years of tight margins mean your reserves are thin. Get 6 to 12 months of expenses in liquid savings first. Then, redirect the freed cash in this order. Max your 401k employer match, that's a guaranteed boost immediately. Max your Roth IRA, $7,000 in 2026, tax-free growth forever. Max your 401k, $23,500 limit. Fund your HSA if eligible. Everything remaining into low-cost index funds. $1,700 a month through that system at 8%, $312,000 in a decade, $1 million in 20 years. Here's what matters from today. Mortgages consume 44% of average take-home, 15 points over the safe limit. $1,700 freed up and invested grows to $1 million in 20 years. Eliminating debt measurably improves mental clarity, decisions, and physical health. Paying off early can cut your financial independence target by $510,000. Bi-weekly payments alone remove 6 years and $89,000 in interest. The mortgage was never just a bill. It was a permission slip you had to check every time you wanted to do something different with your life. I'm curious to hear from you. Are you making extra payments on your mortgage right now? What's the first thing you'd do with no mortgage payment? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.